Okay, so here's how we're going to solve this. First, we have to recognize that 150,000 represents 16.6% of the total now combined equity of the company. So if we're going to raise $150,000 for a business that's worth $900,000 in equity, that means that 16.6% of the total equity of the business has to be owned by the people who provide that 150,000. Okay, so how do we actually solve for how many shares that represents? Well, that becomes a simple sort of algebra problem where 16.6% equals, knowing that we currently have 100,000 shares outstanding. Remember, we started in 90,000, we issued another 10 for ourselves. We have 100,000 shares outstanding, and we have a base of 100 plus X, right? So rearranging the terms, we're going to get X equaling, so let's break this up. So X equals 20, right? And just to confirm that in your mind, 100 divided by 1 plus 20 equals 16.6%. So you're going to have to issue 20,000 new shares. So here's our answer, 20,000 shares. Here's the explanation if you want to work through that math again on your own. But basically, the way to think about the share price now is realizing there's 120,000 shares with $900,000 of value. If I issue 20,000 new shares and that gets me 150,000, we're talking about $7.50 per share at this point. So now we can actually look at the balance sheet, the original GAAP balance sheet, and see that instead of $500,000 in equity, remember that was the original amount, now we have 650, and that got us an extra 150 of cash. Remember, we had 90 before, and now we've got an extra 150. And the same thing on the other hand, we had 500 in equity here. This got us an extra 150. But now we can introduce this sort of hypothetical market balance sheet. Companies don't have to disclose what their market value of assets looks like on their balance sheet and liabilities. But it's helpful just to conceptualize, as we'll see when we start talking about distress, to look at this balance sheet from a market perspective. From a market perspective, if we know that the equity value of this business is $900,000, and the liabilities are all, let's assume the market value equals the book value for now, what we're looking at then is an imputation that, if you add this 900,000, which is the market value of the equity, plus the market value of the liabilities, you get to 1.4 million in total liabilities and equity. That lets you back into the implied market's perspective of what the total assets are worth, right? Because assets must equal liabilities plus equity. So if we've got this business worth, 1.4 billion, there's 1.4 million in liabilities and equity, we must therefore have, by implication, total assets of 1.4. And that's important to understand that the market balance sheet lets us sort of impute what the value of the assets must be. We can actually separate it a bit further, since cash is cash and the market value of cash is the market value of cash. So we have 240,000 of that 1.4 million. We know what that is. The rest of it is all these assets, the property and the flooring and all these things working together, presumably generating operating income going forward. Whether that's worth the value of your business from a go-forward perspective as opposed to a pure book value perspective, as we are required to look at under GAAP. So let's just take that a step further and just take a little bit of a sidebar here. How do we think the bank actually came up with that $900,000 valuation? Well, ultimately, it's based on what they think investors are willing to pay, right? The bank will price the equity. If this was an actual equity offering, the bank would price the equity based on feedback solicited from potential investors and then iterate towards a share price. Now, how do investors get a sense of what they're willing to pay? Well, it's a function of the current market sentiment. It's also a function of valuation analysis. They would probably look at comparable companies, comparable transactions. They would probably look at a discounted cash flow valuation. All of that plays a role in the pricing. And here we have a DCF that sort of shows you how one might arrive at an equity value of 900,000 in this case. So if we assume, for example, that free cash flows to this business are going to be 54 million and growing over the next 6 years, and we made an assumption for a discount rate of 10% and an exit multiple of 8 times. Again, the goal of this particular video is not to walk you through how to build a DCF. We have courses for that, but for those that are basically comfortable with how to run a basic DCF, you see that this, something like this might give us an enterprise value once we calculate the present values of all of these cash flows. You get something like like this, 1.1 million, and then you have some net debt on your balance sheet. Remember, we had we had whatever it was. Let's go back here. We had $240,000 of cash. We had about $500,000 in debt, so net debt of 260. And so you would take 260 from the 1.2 million, and you get to an equity value of 900. So hypothetically, these are the kinds of analyses that implicitly back into why the equity value is what it is, why you can offer 16% of your company for $150,000. So all of that plays a role. And remember, valuation is as much art as it is science, which means that in the same way that this kind of valuation can lead to a really nice valuation for a company, as we'll see shortly as the company enters into distress, this kind of shifting expectations about revenues, about margins, are all going to maybe decline, leading to lower values. And we're going to see what the implications are on the balance sheet. So now let's just kind of go on with this, with this example here, and let's assume that post stock offering, so you've gotten the $150,000, the renovation goes well, the company's enjoying higher rents, even higher than they originally expected, and so many people looking at your company now believe that based on the DCF, they've sort of crunched the numbers, and they're saying, hey, revenue growth is higher than we originally thought. Margins are a little better than we originally thought, and our business isn't worth 900,000 anymore, it's worth 1.2 million, right? So each one of your 120,000 now in total shares are not worth $7.50 like they were a moment ago, but now they're worth $10 per share, driving that market valuation of 1.2 million. So we see how just expectations about future is changing the market balance sheet, and we can see the market balance sheet reacting to that, right? So the market balance sheet is saying, okay, well, if this business is worth 1.2 million in equity, well, then we can impute an even higher asset balance. Right, notice that it doesn't matter what the market is saying. The GAAP balance sheet, on the other hand, remains completely unchanged. Nothing has changed since the original stock offering, where you got $150,000 in exchange for this equity. So continuing, we're getting into kind of we're very happy. We started this business, put in just $450,000 of our own money, and now the business appears to be growing pretty heavily. You continue to enjoy great momentum. You're even able to demand better credit terms with vendors. On top of the $20,000 in invoices outstanding for your hardwood flooring, you've also purchased an additional $90,000 in furnishings on account. So you had 20. Now we've added another 90, and of course that adds to your asset balance, right? So that's the debit and that's the credit, an extra 90,000. This was 20. Now it's also 110. On the market balance sheet, again. Same as before, no real changes on the equity side here. This hasn't changed the value of the business in any, but again, we have the same credit and corresponding debit. The debit here is sort of lumped into this net operating asset value based on what the market is valuing. So now you're getting very confident about your abilities to run your business, and you embark on an acquisition strategy where you buy businesses with a portfolio of investment properties. You want to increase the size of your business because you think you can continue to grow equity. So you find and ultimately acquire a suitable business comprised solely of properties. Let's assume for simplicity there are no liabilities sitting on the balance sheet of the company that you're acquiring, and you buy this company for $200,000. Now, you finance the purchase of this with an 8-year, $200,000, 10%, in this case, unsecured note. Okay? So let's keep that in the back of our minds. But similar to your own balance sheet, the acquired business's GAAP value of assets is only $20,000, far lower than the $200,000 purchase price. And so it's just some basic accounting. When you receive acquired assets where the GAAP value is much less than the actual purchase price, you have to record that difference, in this case the $180,000 difference, as goodwill. Now, the next point to keep in mind is the market loves this acquisition, and they love your general strategy of acquiring companies because the market has gotten used to you doing a really good job, and so your share price, based on presumably higher cash flow expectations and all that good stuff, you would hope that that's what it's based off of and not some sort of irrational market move. But in any event, the market price of your shares have shot up from $10 to $15 a share. So now let's look at the balance sheet post this acquisition strategy. So with GAAP, it's pretty straightforward. You bought something worth $200,000 market value. And so that bumps up your property value from $950 to $970, right? So it was originally $950. Now you've got an extra $20. And remember, goodwill represents the excess of the purchase price over the value of the assets that are required. And so a new asset gets created, kind of an intangible asset, capturing that excess. And that's the debit. And the corresponding credit in this case is just the unsecured note. So now you have another tranche of debt sitting here, in the liability side of the balance sheet. The market side of the balance sheet is not only factoring this unsecured note in, but what it's looking at is, hey, the business now is worth 1.8 million because the equity value is $15 a share. And recall that we have 120,000 shares outstanding. So now we've got a total liabilities plus equity of 2.6. And remember our process of just imputing the asset value on our balance sheet based on what the equity value is and the liabilities as well. And so what we're seeing is that the market's perspective of what the value of these assets, of the business assets is growing when the share price is going up. And that's an important conceptual framework, as you'll see in a moment. So, and here now we're getting to the point where this is beginning to look like a house of cards. In the same way that markets can get excited about a company's prospects, they can get unexcited. So whether it's company or industry-specific problems or macroeconomic issues, companies can have markets it can get out of favor with investors. So examples of macroeconomic issues are things like the 90s tech bubble, 2008 credit crisis. These all result in markets changing their opinions about prospects of businesses. And so in our case, due to, let's say in our example, a worsening economy, nobody thinks that you can generate the kind of rental income originally used to value your company. And given the high interest payments from your heavy debt burden, you're projected to start losing cash, right? So if you can't generate as much rental income as maybe we thought a couple of months ago, well then your margins start getting squeezed, especially when you've got a lot of leverage on your balance sheet. So here's the situation. If we're looking at market signals for pricing, whereas before maybe the market was pricing you at $15, all of a sudden the market's really, really concerned about lower rents, whatever. It was maybe just company performance, maybe the economy. But let's say the market's really soured on your stock because they don't think you can generate rents anymore. But it's even worse than that. If you look at the trading values of your debt, and remember, debt can trade on markets. Of course, bank debt is usually less liquid, although bank debt does trade, and we can talk about that in a little bit. But these loans are trading at 90 cents on the dollar. This one's trading at 50 cents on the dollar, right? So if you bought, if you contributed $400,000 to this company, you went to sell that loan to someone else, they'd only pay you $200,000 for that loan right now. And the unsecured is doing even worse, as you'd expect. Unsecured is last in line in a liquidation, or I guess last in line before equity. This one's trading at 20 cents on the dollar. So this isn't just that this company has no equity, it's that people don't even believe they're going to get paid back their principal payments. This implies that the investors believe the market's pricing partial recoveries to all of your debt, especially the second lien and the unsecured lenders. Now the vendors are also getting worried. They're catching wind of this, and they're also getting concerned about being paid back themselves. So now let's look at what this means for our balance sheet. So notice no change for GAAP. The GAAP is completely asleep at the wheel when it comes to what the market is doing, right? But the market balance sheet, again, this hypothetical balance sheet that companies don't have to file, but is very important for us conceptually to think about, especially in the case of distress, is that you now have the market value of your liabilities is deviating pretty significantly from the contractual value of those liabilities. Your total liabilities, at least on a market value basis, are signaling from a market perspective, it's $440,000. Your total equity, if you crunch the numbers, is actually only $12,000 at 10 cents per share, right? Times 120,000 shares. And so now if we're imputing our asset value, what you see is that we have total assets of $452,000. Look at how our operating assets have shrunk, at least the market value. So what does this mean for us? Well, one thing that we have to keep in mind is that debt, unlike equity, is actually a contractual obligation. It must be paid. So it's helpful to actually combine the GAAP and market balance sheets in order to just understand to what extent our equity is negative. How insolvent actually is this business? In order to really figure that out, it's pretty straightforward. You bring back the contractual value of the liabilities, keep the imputed asset value in, right? So if the asset value we just figured based on the market is $452,000, And we know that the contractual value of the liability is 810,000. Well, we are in the hole 358,000. So combining the GAAP and the market balance sheets in this way enables us to sort of quantify, at least conceptually, how insolvent we are. So if we sold all the assets of this business today, we get 452,000. We owe 810,000. That's how insolvent we are. So that's a good framework for thinking about insolvency and just connecting that to valuation, which I think is always helpful. If you were to run the DCF after everyone's kind of soured on this company, and all of a sudden you've got, very low rental income growth, very low margins because, whatever reason, the economy's changed or people kind of don't like the assets that you bought, the risk of your business might be now considered higher. The exit multiple that you could expect to get might be lower. And now you've got yourself an enterprise value that is significantly lower than before and an equity value of that 358, negative 358. So that's a helpful way to, again, keep thinking about what's intrinsically driving the market, changes in balance sheet and debt balances or whatever. It's not always apples to apples, as we're going to see. The DCF, you can get it to say maybe something different at different assumptions. This is all driven off of assumptions. But these frameworks become very important for understanding why is the market pricing things in the way that they do.